You are listening to Let the Money Talk podcast, a podcast where our PhillipCapital's experts deconstruct world-class tactics, tools, and routines for managing your finances. I'm Rashawn, your host for Money Never Sleeps. Stay tuned for our experts' top tips.
Good afternoon. I'm Rashawn Gidwani from Pitch Media. Welcome to Let the Money Talk. It's good to have you all with us. Today, we have a very special guest on the program, Mr. William Lim. Hi, William. Glad to have you here with us.
Thank you. Thank you, Roshan, for having me here today. Hello, everyone. I'm William, Financial Services Manager at PhillipCapital. Before I begin, my sharing is purely my personal opinion and should not be construed as professional financial consultations advice. Yeah. So today, let's talk about recession. Is recession just around the corner?
Let's begin. Can you share with us what is the current market condition and are there any signs of a recession approaching?
Well, today, runaway inflation caused by supply chain disruption and a spike in oil and gas prices due to the Russian-Ukraine war triggers warnings of a recession.
Can we get a better understanding of how the mentioned factors could potentially bring the global economy into a recession?
Well, inflation was already at its peak 4 decades before the Russian-Ukraine war, a war between two countries that are vital to the global supply chain of both energy and agriculture is sure to cause inflation to worsen. Therefore, the probability of a recession is much higher today than it was before the war. Although inflationary spikes may not always be the only cause of a recession, they have always been elevated by one. Every single time when inflation went over 5%, a recession could happen either right away or in short order.
Sounds like it would be a good choice to put on our armor to prepare ourselves for a recession. How soon do you think it will happen?
Well, the timing is the tricky part. In the past, we have seen slowdowns after inflation began to drop. Sometimes it happens concurrently. A recession can also come without warnings, just like the Great Financial Crisis back in 2008. When we experience an economic contraction, it will occur in the face of the strongest job markets on record. Reports show that the pre-pandemic high for job openings in the US was 7.5 million, and we're now sitting at more than 11 million. There is no doubt that the job market can change in an instant. We saw it in early 2020. However, my hope is that the combination of a strong job market and a sturdier consumer balance sheets will make for a minor recession.
What can ordinary investors out there do to prepare for a recession if it does come to that?
I think it's important for investors to prepare for a range of outcomes to help them set realistic expectations. There is now a much higher probability today that we may go into a recession than there was just a few months back. Since World War II, we've had 13 recessions in the United States. This means that over the past 80 years or so, a recession has occurred once every 5.9 years on average. The way I would look at it, you're not preparing for the recession, but a recession. There's a difference. Peter Lynch, fund manager at Fidelity Investments for 23 years from 1977 to 1990, once said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections that have been lost in corrections themselves. As we apply that to recessions, how do you prepare for one? Well, it's the same way you prepare your finances for everything else. Instead of changing your portfolio because you think a recession is coming, create an investment plan that is durable enough to withstand a wide range of environments, including economic contractions. Give yourself a margin of safety with a high savings rate and an emergency fund to help you survive a recession. And any number of curveballs life will inevitably throw at you. Losing your job, a crushing local economy, a divorce, an occurrence of a large unexpected expense, or simply a poor investment decision can cause you to lose a whole lot of money even when the markets are doing fine. The point here is that you don't prepare for a recession by trying to figure out the exact start and end dates of the next slowdown in GDP. Not only is that impossible to do on a consistent basis, it probably wouldn't be much of a help to you at all.
Could you then give us some examples of portfolio strategies that investors could adopt to help mitigate the risk of recessions?
Well, your risk profile dictates your asset allocation. A medium risk profile should give a range of 50 to 70% equities in your portfolio. Likewise, a higher risk profile should see a range of 80 to 100% of that in equities. Do revisit your portfolio's ability to tolerate volatility and drawdowns, as this will also help dictate the level of equities in your portfolio. The act of periodic rebalancing can also enable you to navigate through bouts of market volatility without having to time the market, and thus removing the guilt of missing on market dips or giving up heady gains. Asset allocation will help investors steer through a storm, while rebalancing periodically will help prevent from doing too much or too little to their portfolio during both good and bad times. If you are looking to optimize your financial portfolio, please do not hesitate to contact me at bit.ly/TTP William Lim, as in WILLIAMLIM.
Awesome. Thank you so much, William. That has been very insightful. You can follow our Phillip Wealth Advisory Facebook page at www.facebook.com/Phillip Wealth Advisory for more. Stay tuned for our next offering, which will be released soon. Also, tune in at 10 a.m. on PhillipCapital's YouTube and Facebook page for Singapore's most up-to-date financial news, the Daily Morning Note. See you again.
Thank you very much for listening. If you enjoyed this podcast, please forward it to others, share it on social media, and leave a review. Follow this channel for other podcasts.